welcome. You're watching a fresh new edition of the Moneycontrol Show. I'm Sakshi Batra and this is where we talk about macros, markets and money. On the show today, we will talk about investing in non-convertible debentures. And we'll also discuss about the draft legislation on the new direct tax code, which was submitted to the Finance Minister Nirmala Sitharaman this week. And we'll get you insights into the stock markets and the cues you need to watch out for in the coming week. Well, in the last 10 days or so, at least 5 companies have issued non-convertible debentures or NCDs, which are a very popular option with investors as they offer interest rates higher than the bank fixed deposits. But the non-banking finance companies at large are still facing a liquidity crunch. So are these NCDs worth your while, or are you better off putting your money in banks or perhaps even in debt funds? Moneycontrol's personal finance editor, Kayezad Adajania, is here to tell us more on that. Hi, Kayezad, and thanks for joining us. Well, lots of NCDs have actually hit the markets in the recent past. Tell us what these NCDs are offering us this time around.
Hi, Sakshi. Yes, so there are a lot of NCDs out there in the market these days. Close to about 5 NCDs are on offer. They're offering very attractive interest rates from 8.45 for a 3-year tenure to about 10.52% for a 5-year tenure. And as I said, there are 5 NCDs, Tata Capital Finance, there is one from India Bulls, there is one from Shriram Transport Finance, JM Financial Products and India Bulls. So at least these 5 companies are out there, and as I said, the tenure is anything between 2 years to around 10 years, and interest rates are also quite attractive.
Kayezad, why are all these companies in the market? In fact, so far in 2019, we've already seen many NCD issues already.
Yes, so there have been a spate of NCD issues so far this year. You're right, Sakshi. Well, the reason being is that, these NCDs are issued by non-banking financial companies called as NBFCs. So NBFCs are lenders in the market, just like banks give you home loans, car loans, and whatever loans that you get. Even NBFCs also lend money. Now, where do they get this money from for them to lend you? They get this money by, raising NCD issues. And they borrow from banks, they raise NCD issues through private placement from institutions, and also they go to retail investors with NCDs offerings. Now, what has happened was that since the last year, since the IL&FS crisis broke out, there has been a severe liquidity crunch in the NBFC space. People are wary of giving money to NBFCs because some of the NBFCs have either defaulted on their principal payments or they have delayed interest payments. So when this crisis happens, it becomes a little difficult for NBFCs to raise money through private placements, as I said, most debenture private bond issues happen through private placements. So which is why they are turning to retail investors like you and me to raise money for their lending requirements. So that is why we've seen a spate of NCD issues so far this year. So that's one reason. Second reason is, of course, because of the slowdown in the economy, consumers are spending less. So if they're spending less, they're borrowing lesser and lesser. So obviously that also has been has put the business of NBFCs in a slightly tighter condition in the past 6-7 months to 9 months, and which is why also this has compounded the crisis in the NBFCs as far as raising money is concerned. So which is why we've seen a spate of NCD issues so far this year.
Kayezad, since all NCDs actually come with credit ratings, should investors just go with the issue that comes with the highest credit rating? And also sometimes we only get NCDs with an AA rating rather than an AAA rating, because that are rare to find as well. So what should one really do in such cases?
That is right, Sakshi. In fact, in the current offering of NCDs, which if you see, there's only one company, Tata Capital Financial Services, that's offering a AAA rated NCD. The rest of the NCDs are either AA or AA plus. Okay, so obviously the higher the rating, the better is the NCD, because the chances of it giving you interests on time and the chances of paying your principal on time are high. So the probability of timely payments are obviously high in a AAA rated NCD. So obviously, given a choice, you would want to go for a higher rated NCD. But even AA and AA plus NCDs in many cases are also decent enough, because one, they offer you a slightly higher interest rate if you are willing to take that much amount of risk. And also, some of the companies offer you NCDs that come with higher rating, like AA or a AA plus, or also decent companies in which you can invest in. So that's as far as the rating goes. But given the way the credit ratings of these NCDs and various instruments have also played out in the last 9 to 10 months, you have to take credit ratings with a pinch of salt, because we have seen credit ratings deteriorate very swiftly in the past. There have been instances. So obviously, credit rating is not the only thing that you have to see. You have to, that's a starting point. And also you have to dig in a little deeper, talk to your advisor, talk to your distributor, read about some news about the companies in which you are investing. And, if you find a lot of bad news around that company, it's better to avoid the company. So all in all, look at the credit rating, but that's not the only thing. You have to take it with a pinch of salt these days. That's number one. Number two is that apart from credit rating, you also have to see whether your NCDs are secured or unsecured. Now, most of the NCDs in the market would be secured NCDs, but there would be an occasional NCD which would be an unsecured NCD, typically an 8-year NCD or a 10-year NCD. You have to look out for that factor as well. Now, what happens is that if you invest in a secured NCD, okay, and if something goes wrong with the company in future, a secured NCD and all the other secured creditors would be the first in the line to claim money if anything goes into liquidation. But if you invest in an unsecured NCD, they would be the last in the line to claim any any dues that the company can pay after liquidating its assets. So between a secured and an unsecured NCD, a secured NCD would be a little bit safer than an unsecured NCD.
Kayezad, what's the usual tenure that you recommend to investors, as most NCDs come with the tenures of 2, 3, 5, 7 and also 10 years?
Typically, I would say 3 to 5 year tenure is good enough. Anything less than 3 years is too less for you to take a risk by investing in an NCD. A bank fixed deposit would be good enough. And anything more than 5 years, at the current point in time, it would be a little too risky to give away your money for such a long period of time. So 10 years is a strict no-no, but even 8 years also at this point in time would be a little risky. I think 3 to 5 years would be an ideal time period.
Kayezad, there are also listed NCDs out there in the market. So do investors have a choice to look at them as well, or must one go in for fresh NCDs only?
Investors do have a choice, in fact, to go for listed NCDs also. But remember one thing, that NCDs which are already listed are like a moving train which you have to get into. Okay, so it would have obviously spent some time out there, and only some time would be left for the NCDs to mature. So let's say if you want to invest for a 5-year tenure, there could be a 10-year NCD, or there could be a 3-year NCD or a 7-year NCD already running. So you may not be able to get an NCD listed on the market of exact 5-year tenure. Right, so there would be a tenure mismatch. So make sure you understand that. And the second thing is, obviously you have to see at what price you are getting the listed NCD on, because your return on investment would make a difference over there. Your return on investment could be either lower or higher than some of the fresh NCD issues which are out there. So it's a little tricky to calculate the return on investment on a listed NCD. So do talk to your advisor and your distributor to understand whether you will be earning a higher or a lower return on investment from a listed NCD as compared to an existing NCD, and then you can take a call.
Thanks a lot, Kayezad, for sharing all these insights on NCDs with us. Well, moving on, the high-level government task force on direct taxes, which was appointed to review the existing 58-year-old Income Tax Act, has proposed several changes that could reduce the tax burden for several companies and individual taxpayers. Watch this insight to know more. The Modi government in its previous term had set up an expert committee to draft a new direct tax code. And last week, after working for more than 21 months and conducting 90 meetings, a task force led by CBDT member Akhilesh Ranjan has submitted its recommendations on the proposed direct tax code to Finance Minister Nirmala Sitharaman. Other members of the task force include Girish Ahuja, who is a chartered accountant, Rajiv Memani, chairman and regional managing partner of EY India, Mukesh Patel, practicing tax advocate, Mansi Kedia, consultant ICRIER, and GC Srivastava, who is a retired IRS and advocate. The new direct tax code will replace the 6-decade-old Income Tax Act 1961. The move is aimed at rewriting the 6-decade-old income tax rules by simplifying income tax provisions and improving tax certainty. Mukesh Patel, a member of the DTC panel, said that when the report is unveiled, every taxpayer of India would be keen on paying taxes and every tax professional would proudly say that we have an efficient tax system. The report also contains the draft bill and is understood to have suggested changes to the tax brackets. It seems to have also included proposals to review the surcharges levied on income tax. The capital gains tax regime, minimum alternate tax, and dividend distribution tax have also been reviewed by the task force. The task force has suggested steps to cut litigation and has indicated at making surcharges temporary. The committee seems to have taken into account developments in international tax practices and looked at ways of aligning the country's tax law to deal with the new economy. The government is likely to put the report in public domain for consultations after examining the recommendations. The high-level government task force on direct taxes, which was appointed to review the existing 58-year-old Income Tax Act, has proposed several changes that could reduce the tax burden for several companies and individual taxpayers. Two expert panelists join me in the studio today, Rohinton Sidhwa, partner Deloitte India, and Gaurav Choudhury, Deputy Executive Editor of Moneycontrol, to discuss what the new bill is likely to contain and how will it change lives of taxpayers. Thanks a lot. Appreciate you gentlemen joining on the show. Rohinton, you're the tax expert, and I have to begin by asking you, in the current law, what have been the pain points so far? What are your big expectations from the upcoming bill, the new direct tax code, and how will it really change the lives of taxpayers, both individual and corporates?
So Sakshi, I think the big thing that we are really worried about is the certainty of outcomes. So we might have a complex law. We are not worried about the complexity in the law. But as long as certainty of outcomes is something that is guaranteed under the existing law, that's something that we are looking forward to.
Yeah.
The amount of tax litigation that the current law has spawned is tremendous.
Yes.
And there have been a number of measures that the tax department has been taking to reduce that, including things like having a limit in which the department goes and files an appeal at tribunal levels or at the High Court or the Supreme Court. So if this law reduces the amount of litigation, that I think would be a positive outcome.
All right. Gaurav, I'll come to you next. We've already seen in the first term of the NDA-led, BJP-led NDA government that there was an overhaul of the indirect taxes in the form of GST. That was the boldest indirect tax reform that we've seen in the country. And now this is the step towards reformation of the direct taxes. Is it going to be as bold and reformist as the indirect taxes?
Well, at least there's some promise to do that. And I would assume it will be far more structurally more significant than indirect taxes, because this involves individuals, whereas in the case of indirect taxes it involves businesses.
Yeah.
So it is not just about individuals; it's also about corporates and small business and the entire business landscape of the business community. As also, it'll have a bearing on people's saving patterns and saving habits.
Yeah.
It'll have a bearing on people's income levels, and it'll have a bearing on simplification of rules and procedures.
Right.
All in all, I would expect this will be far more significant in the sense that people will be able to relate it far more as compared to what it did during the GST rollout.
Absolutely. Rohinton, I have to ask you about the big expectation that all the individual taxpayers really have from this on the personal income tax front. What we're hearing is that the panel has actually, the high-level panel which has drafted this new code as well as the bill, has actually, recommended changes to the tax slabs. So what could these changes be? What kind of revisions are we able to see? And will this actually put more money in the hands of individuals?
So that's a $1,000,000 question. So so currently our maximum tax rates peak at a very significant level. This time the budget increased it for high net worth individuals. But really, if we are to compare ourselves with countries around the world, typically a peak rate of maybe around 30 to 35% for individuals is probably a good place to be in. The question that we really need to get into is how does that support the growth of our tax to GDP ratio? Typically our tax to GDP ratio has been languishing between 5 and 6% over the last few years, and if you look at most countries around the world, so even Brazil, so I'm not even comparing ourselves with developed countries.
Right.
If we look at even Brazil, that's in the range of 7%, China is higher than that. So really we need to go ahead and increase compliance. And today the bane of our tax system is that there's this bunch of taxpayers, the salaried class, who actually foots a significant amount of tax rates. The regular companies, the big companies, are paying a significant chunk of direct tax. It's really the traders, the professionals, the individual entrepreneurs
They are bearing the
who
whole brunt.
seemingly are not actually paying taxes, and that's the big part. So if you look at the Indian middle class, we have statistics which say that the Indian middle class is anywhere between 60 crores to 100 crores. We have 8 crore returns which are getting filed year on year. So there's this big gap that we are seeing, and unless the department can do something significant to address the gap, reducing tax rates for existing taxpayers is difficult. We still have to balance the books. If you look at the mixture of indirect tax to direct tax, so direct tax progressively is now contributing about 50% of the total tax kitty. Maybe it had gone a little higher, but it's now again back to between 40 and 50%. If we really need to drive direct taxes, this bane of non-compliance is something that we really need to target.
Right. We'll talk about non-compliance also a little more, and how will this bill actually push towards more compliance. But Gaurav, the one key expectation was around the corporate taxes, to ease the tax burden on India Inc. as well. The government has been doing that time and periodically in the budget speeches as well. We have seen that happen. But so far, again, the taxes are quite high. This time around, there is an expectation that it will come down to 25% for everybody, for 100% India Inc., not just 99.3%, which is existing right now, and also eventually phasing out. Will this really push investments in the country, which is really reeling under the economic slowdown in the country?
That is one big expectation. That is one of the headline expectations of the corporate sector. In this budget, we have seen that it has the headline corporate income tax rate has been brought down to 25% for those companies with a turnover of up to rupees 400 crore annually. The expectation is that the headline corporate income tax rate will be 25% for all companies, including that includes all companies with regardless of whatever the turnover is. But the more important thing to watch out here is what is going to be the effective rate of tax. As of now, the effective rate of tax is about anywhere between 20 to 29%, depending on the size of the company. Even if the headline income tax rate actually comes down to 25%, but the effective rate remains around 27, 28%, the net effect on companies would not be much. So companies would be, while hoping for a headline rate of 25% across the board, would also be hoping that the effective income tax rate actually comes down to 25% or even below. And also important thing to note here is what kind of the sunset clauses that the Direct Tax Reforms Committee has recommended for the plethora of exemptions that have crept into the Income Tax Act over the last 60 years. And on many occasions, the Income Tax Act and the rules actually sound like gobbledygook. So to what extent is going to clean up the system, clean up the rules, make it simpler, make it procedurally far more easier, is something that's going to be cleanly watched out for.
All right. Rohinton, I have to ask you about, there is the whole buzz about doing away with DDT, MAT, also branch of profit tax on foreign companies. What are your thoughts on that?
So I think doing away with DDT is an excellent idea. It's created incongruencies in the way people invest. It's bad for foreign direct investment. It's resulted in certain types of unwanted planning that high net worth individuals have done. So doing away with the dividend distribution tax is a great idea. With regard to MAT, I'm not so sure, while obviously the rate of MAT coming down is probably a good thing, but just doing it away is completely in one stroke is to some extent a little scary for corporates especially. Because what happens with the MAT is that you end up paying tax on your book income in a particular year and you carry forward those credits. Now, any kind of system in which we do away with MAT needs to address is what do you do with the existing credits, and then thousands and crores of rupees that companies are now carrying on their balance sheets. And if we in one step do away with the MAT, we'll have red across several large corporate balance sheets, because you'll have to then do a straight write-off of that MAT credit. So any kind of doing away with the MAT credit, MAT needs to look at that as well.
Absolutely. Thanks a lot then, Gaurav and Rohinton, for sharing with us your thoughts and also the key insights on this new direct tax law, which has been drafted in line with the norms prevalent in other countries, also incorporating international best practices and also keeping in mind the economic needs of the country. We'll now just have to wait for the report to be put in the public domain and also see how soon can this be implemented. Moving on to markets now, Santosh Nair, editor of Moneycontrol, joins in with all the action in the stock markets and cues for the week ahead. Thanks a lot, Santosh, for joining in. Well, weakness continues to persist in the markets as bulls are facing tough resistance at higher levels. What is the big worry for the markets right now?
Well, thanks, Sakshi. The mood is very bearish out there right now. The market was pinning its hope on some kind of stimulus announcement by the government, but going by the chief economic advisor's comments, it looks unlikely that the government may announce any fiscal stimulus package. So you could see some more selling pressure in the market in the short term. Already stocks have taken a fair bit of beating. You're not seeing any buying support from the foreign institutional investors. That's been one of the main reasons why you've seen so much of pressure on the stock price. That trend could possibly continue in the short term. You're seeing some bit of money coming into mutual funds, but that somehow doesn't seem to be good enough to support the market. In fact, people are now losing confidence on some of the frontline stocks which they feel are quite richly valued, given that the earnings pickup clearly is not there. So overall, the sentiment remains very worrying, given that the mood in global markets too is bearish at this point in time. So we are likely to see the downtrend in stock prices continue for some time. It may not be a one-sided slide because as you've been seeing over the last few weeks, there are these occasional rallies, and after that again market keeps slipping. So the near-term trend clearly is downward, although you could see now the market drifting lower slowly instead of falling in one straight line.
Santosh, what were the key highlights from the RBI and FOMC minutes and any indications for the markets from there?
Well, if you go through the RBI minutes, clearly there is a lot of concern over growth. So what the minutes are saying is basically that inflation will most likely, in fact, the RBI is confident that inflation will be under 4%. The central bank will meet its target on that front. However, growth remains a very big concern. So what you're likely to see is some more easing by the central bank probably over the next few months. But as we have seen so far, there's a big lag in the transmission of the rate cuts by the RBI. In other words, you're not seeing the banks cutting rate, even though the RBI has been cutting rates. And earlier this week, there was also some talk about the RBI Governor Shaktikanta Das saying that the bank rates should be directly linked to the repo rates so as to ensure better transmission. That still remains to be seen. And for the moment, while you're still seeing the interest rates going down, businesses are still finding it difficult to raise money. NBFCs are wary of lending. That's the case with banks as well. So there are concerns out there. As for the FOMC minutes, you're seeing that the signals from the Fed are a little mixed. However, the market is still hopeful that you could probably see one more rate cut before the year is out. Whether that will make much of a difference at this point remains to be seen, but that's what people are expecting for now.
All right, Santosh, and what are the big cues and triggers to watch out for in the coming week then?
No major triggers really, except that it's the expiry of the derivatives trade on the NSE next week. So that is something that will be closely watched by players. In fact, you could see some more bit of volatility there, given that already market has been quite volatile this week. There is the auto sales coming up, but it is the week after next. So For next week, the market will be focused on derivatives expiry.
Thanks a lot, Santosh, for all that market update. Let's wrap this episode here, but you stay logged on to moneycontrol.com for more news and updates on markets, earnings and more. Thanks for watching.